Hey, how's it going, everybody? Hope everyone's having a wonderful evening. Today, we're going to go ahead and jump into our stock options for beginners lecture and presentation from us here at SoCal Trading Group. The same instructions, the same beginner concepts that I go ahead and share with my students, I'll be sharing with you guys here today. And I really want to share this information with you guys because trading stock options is very volatile, very aggressive. It's high risk. You can lose a lot of capital, and I really want you guys to avoid all the mistakes that I made, in my trading career, struggling, without these kind of concepts and no one teaching this to me, right? And when trying to learn trading on social media and YouTube, sometimes these concepts can get mixed around and overcomplicated by different people presenting the information differently. So I kind of kept this very beginner friendly, very introductory friendly, things that I could understood, that I think I explained very clearly to all my other students. So I hope these are able to help you guys, avoid all the losses and kind of become profitable a little bit quicker. There is more advanced concepts that I did leave out that I, do kind of wait for more intermediate option traders to present and share with. Those are kind of more included with my clients once I already build the experience up with them. But this is my stock market for options for beginners presentation and lecture. I hope all of you guys enjoy. If you guys don't have any experience with trading options yet, this should be able to help you understand a little bit what it is. So let's go ahead and jump into it together. So first of all, what is a stock option? It's not here, but I'll go over it with you guys together. A stock option is a contract that gives you ownership of 100 shares of any given company at any share price, going for a prediction of share price either moving up when you'll be placing a call option or moving down where you'll be placing a put option. The con to this is that every stock option contract has an expiration date. So you have to make sure that your trade or your investment is profitable before given expiration date. And I'll go ahead and jump into the here, through the terminology. So a strike price, like you heard me mention, the share price you believe the share price will reach going up or down. Very simple. Let's say we're trading at Apple, $100 a share. If I think Apple can go up to 105, that will be a call option with a 105 strike price. If I think that we are at a current share price of 100 and Apple can go down to 95, I will be looking to place a put option with a 95 strike price. It's where I believe as an investor and trader where share price can go. So the next terminology is the call option. The call option is what we use as a beginner trader using level 2 strategies to predict where share price will go up towards the upside. So the option you buy when you believe share price will go up. Very simple. So if we're at $100 a share, like I mentioned earlier, and we think based on some news and data that share price can climb up to 105, I will be looking to place a call option as I believe share price will be going up. The next one is a put option. A put option means you want share price to go down. So it is the option you buy when you believe share price will go down. If Apple is facing some aggressive tariffs, maybe slowing down in manufacturing, they can't resource supplies, and you think that share price can go from 100 down to 95, you will be looking to place yourself a put option as you believe share price will come down for you to make a profit. Finally, the next component of a stock option is our expiration date. Expiration dates are kind of how long you have with this contract. It's when the last straw, the last day you have to make money, be able to profit, or either, just be with this contract and this investment, this asset to you, is going to be the expiration date. Meaning that if I think that Apple can go up to 105 based on good news, hey, if I think that this can happen by the end of this Friday, I'll be looking for a May 22nd expiration date. If you have, some hunches that maybe the new iPhone 17 coming out, it can create possibly an up you can say direction or an increase in share price for Apple in the next month, hey, you will be looking for a next month expiration somewhere in the month of June. Just to kind of add a little bit more context here. So it's the last day you have to make or lose money with the contract. Finally, you have the break even, the share price you need to reach to make back your initial investment. So I share this with you guys because a lot of people don't really understand this concept. So when you buy an option contract, you have to first be able to make back the money you invested. So your money's deployed. once you, let's say like a hand of blackjack or just one-to-one investment, you put 50 bucks, you want to make 50 bucks back, that's your break even. So sometimes when picking a contract, you want to pay attention to what share price you need to achieve to make back your initial investment. And that would oftentimes be used for me as a guide as to where I want to set my strike price, which I break down here. Pro tip: try to use your break even as a potential strike price so you're more in the money. You're a higher probability of achieving a one-to-one return later on, furthering increasing the option premium where you make $1 per every 100 shares that you own, furthering increasing your gains. For those of you guys that don't understand how that works, go back to my options for beginners video here on my YouTube channel, and it'll be a very good resource to help you guys navigate that. So stock options risk, the key risk every option trader should understand. I go over it now in this presentation. You guys are supposed to be understanding risk. There's a lot of components in the strike price, the expiration, the technical analysis, the setup, the research. So be aware before entering stock options the risk. You know, one very big silent killer that I don't see too many people talking about with you guys when specifically trading stock options is time decay, your theta. Options lose value daily or sometimes per minute, per hour as they approach expiration. It can erode your position even if direction is correct, meaning that if I'm pushing towards the end of the lifespan of my contract and I'm near the end of the expiration date, despite me being at, let's say, a strike price of 105 and share price being at 105 or 104, my contract isn't going to make me too much money. Why? Because it's at the end of its lifetime. It doesn't have too much probability for it to go higher than 106 and make me more profits. So sometimes when trading these contracts, you always want to be aware of what is time decay, what am I looking at, how soon do I want to be out of this position, so you can avoid losing contract value to theta, which we'll go ahead and kind of break down in another example later on in the presentation. So implied volatility crush. So sometimes, for example, last week we see companies like AMD, Nvidia, Tesla have very aggressive moves towards the upside as we had tech earnings. A lot of rush, a lot of commotion came into this sector, a lot of money came in, boom, all the noise, everything went good. Party's over, people go home, money comes out. So implied volatility crush, you want to be aware of these events where they draw in a lot of buyers, a lot of volume, but once the volume comes out and gets away, boom, these share prices can come back down. Something to be aware of as an option trader when you're trading call options. Liquidity. Wide bid-ask spreads on liquid options can cost you significantly when entering or exiting. So always being aware of how much it is you're exposing, you know, how much money is it that you are comfortable with risking to, I guess, high risk investments, right? Which I go over in my personal finances with all of you guys, is watch your short term and your long term. You know, continue to invest in stocks long term with the vast majority of your investing income from the personal finance video that we just recorded. But go ahead and also use, you know, your short term to a limit with these option trades, because they are very high risk. And unlike stocks that, you know, you can hold for 5 years and no matter what happens you'll probably make money, unlike stocks, options here, these guys, if they hit the expiration, your capital that's invested can go completely to zero. It will be gone and you'll never see it again. There's no asset that's being held for it further than the expiration date. Once it hits the expiration date, the life of this investment is over and done. So be aware of that. And sometimes I'm asked, Jerry, can I lose more than what I buy the contract for? Nope. If you have $5,000 in buying power, the contract costs you $1,000. You're only going to lose $1,000. That's the most you're going to lose. It'll never buy back into your buying power. It'll never go back into your buying power. Next is the leverage risk. Small moves in underlying stock can cause massive percentage swings in your option value. So if you're inexperienced and you're buying contracts that are out the money, and sometimes, you know, you face these volatilities, and sometimes you face these volatile assets where they move up and down very aggressively, you can run into the risk at that point of losing significant amount of percentages or gaining a significant amount of percentages that you have to be prepared to navigate and react quick to take profits or get out of the position in case you have to minimize losses. Finally, is the assignment risk. This is why I stick to buying options, not selling them. Oftentimes, well, when people run into selling options, there's a liability behind selling options where you might have to put up the capital to buy all those shares in case someone doesn't, I guess you can say, exercise your contract. So stick to buying options. That's what this presentation is going to be primarily about, just to clarify that before we get in. And I highly recommend that you guys start, really understanding the risks that come with options so you're prepared for it and you know how to allocate your capital with the right intentions behind it. So options involve significant risk and are not suitable for all investors. Please understand this is a high risk, high reward game, but it's one that you can learn and experience and get better at. But you are going to be running the risk of going through that learning curve and potentially losing a significant amount of volume or capital if you're not prepared for it. Finally, option trading. What do I want to be trading if I'm starting with low capital, right? So oftentimes I have beginners that, Jerry, I want to get into trading. I like the concept. I want to do this full time one day. But I don't really have too much right now. And that happens all the time, man, believe it or not. I also have individuals that are loaded. I have, my buddy Ernie in Michigan, gas and petroleum company doing 20, 30K a month easy. I have other successful business owners that I surround myself with that oftentimes do have the capital to go into this big, but I give the same rule for everyone. Start with low capital. No reason to learn a $100 lesson losing $1,000, $2,000, $3,000. Lose the lesson with $100 so you gain the knowledge without exposing too much of your capital. So I oftentimes recommend beginners trade cheap assets. When you're going to build in your experience with option trading, you're going to notice that some contracts are more than others. And the ones that have less expiration, meaning they are closer to expiring rather than the ones that are further from expiring, a contract that expires this Friday is going to be much cheaper than the one that expires in the next 4 months. So sometimes picking the contracts that have a closer expiration while starting with low capital, it's a good way to minimize your exposure of capital losses, but also now getting your experience in without paying that high cost for it. So when trading, what option contracts you want to be buying. ETFs, they're great. S&P 500, Invesco, QQQ, Russell 2000, their tickers are SPY for SPY, QQQ for Invesco, and IWM for the Russell 2000. These assets have a lot of volatility, also allowing you to make significant returns based on if you enter and time them correctly. So this is a great learning curve, great experience to allocate low capital, but building up your experience. When trading these, it's highly recommended that you guys go for expiration dates that are going to be 0 DTs or 5-day DTs. Why? Because 0 DTs allow you to go in with low capital, but 5-day expirations, what we call intraday trades, allow you to sometimes be wrong in the short term, but come out positive in the long term, which I'll break out into you guys how it is you guys want to navigate even certain strike prices, expiration dates before entering, how to think about them. Finally, the next kind of group of assets you want to be trading are the Magnificent Seven. So these are independent companies, they're not ETFs. These are going to be your companies like Tesla, Microsoft, Meta, Nvidia, Google, Broadcom, Apple, Amazon. These contracts sometimes have 0 DTs, 2-day DTs, and 5-day DTs, still being much cheaper and allowing you to, once again, trade that volatility. Volatility is when a stock price goes up and down very quickly, allowing you as a trader to make pretty decent returns. And I always recommend, when trading these assets, like I said, starting with $100 doesn't hurt nobody, man. So practice with low capital. A $100 to $1,000 challenge is very healthy for beginners. It's a challenge to 10x your money. It's a challenge to overcome that initial kind of small profit taking to build up the capital, and then that maturity and discipline to scale it to the 10x, right? So I hope you guys can kind of learn from those challenges and really get your feet wet when trading options with no more than $100. Knowing when to enter and managing risk when trading options. This is a very key component when trading options that I tell all my clients about. There's 5 pillars of risk management, really almost 6, which we'll jump into at the end, but it's kind of just a concept that you got to know about. So the 5 pillars of risk management are your strike price, your expiration date, your setup, your technical analysis, and your research. You're going to want to combine all of these to give you the most advantages, the most evidence, the most tools in your hand to get the job done and correctly and safely. So let's go ahead and jump into managing risk with your strike price. Managing risk with your strike price. So understanding, like I said, basic concepts here. In a call scenario, if current share price, where we see the end of this chart is at $100 a share, any share price, or strike prices, I should say, around this 100 range, whether it be 103 or 102 or maybe 199, 98, they're kind of close to the money, which we call, the money is just the current share price. So at the money strike prices, right? So at the money strike prices are going to be what we consider somewhat of a medium risk. They allow you to make profits without being too exposed to high risk as if you were buying out the money. But also if they come down, the losses wouldn't be as bad if they were out the money. So this is a great way to minimize risk by buying closer to the share price to allow, hey, maybe some drawdown without too much percentage losses compared to buying out the money. This also allows for, some investors to have more security when trading their options. When you're buying in the money or out the money, sometimes in the money you are paying an extra for a premium, and out the money you're paying cheaper for higher reward. So the next one is out the money. This is high risk, and this is where I kind of recommend as beginners, you guys kind of get your feet wet, but be very careful around because they are higher risk. As a beginner investor, retail trader, you want to be cheap. You don't want to spend too much money. Man, those ones at the bottom are kind of expensive on the option chain. I like the ones that are closer to the top when I'm in my call options because they're cheaper. They are cheaper, but you need bigger changes in share price to be able to profit generously off of those moves. And that's something you have to be aware of that many people don't tell you. So despite them being cheaper or more attractive because of their price economically, the risk behind them is much higher. And the ones that are more expensive in the money, below the current share price, these ones are a little bit more safer. They don't make too much return, significantly, but they also do reduce risk a lot. They help you become more confident in this position because you're not too much at risk being out the money. So that's how you manage risk when picking your strike prices. Out the money on a call option is going to be high risk. At the money on a call option is medium risk. In the money is going to be more lower risk. And put scenario, everything's kind of the same, it's just flipped. So now with current share price being 100, every price near maybe 101 or 99, those are going to be our at the money strike prices. Medium risk, medium reward, good way to kind of minimize those losses. In the money, anything now above, right? We're coming down. So 110, we're right here at 100. Hey, 110's already happened. We're already far below that. So buying 110 in the money, hey, now I'm reducing risk in case this decides to come back up. I'm not going to be losing too much, allowing me to, hey, maybe if I'm wrong, I don't lose too much percentage gains, but if I'm right, I'm able to make some little money right here, something more secure, safer for my capital to be in. Then you have your out the money, everything below 100. This is where, hey, these are more cheaper, but we got to get there. We have to have a little bit more evidence, a little bit more maybe expiration to make sure that we can achieve this, right? And we'll jump into the expiration dates here on the next slide, and that concludes here strike prices. So managing risk before entering with your expiration dates, you have to know what are the highest risk scenarios, the medium risk scenarios, the low risk scenarios with your strike prices. And I keep this kind of simple, right? Day trades, zero DTEs. These are the ones that often people go for because they're cheap and affordable, but they are the highest risk you can take. So day trades happen here on a Pacific Standard Time basis from 6:30 a.m. to 1 p.m. Market close is your day trade. You use these when scaling small capital, when maybe there's a really big headline that just came out and you want to react to it in the same day. Maybe you're trading some FOMC news and you want to just make some quick money because you have a hunch on what could potentially happen here. These are when you really want to have a little bit more evidence before taking these, or, you know, trying to scale small capital but with the proper risk management, because these are the highest risk of trading, just because they expire in just one trading day. So you have a very short amount of time to be right or be wrong. And if you're wrong, you have to start thinking about theta, because these are very highly impacted by that time decay, that I guess you can say depreciation of the asset. So the next one is your intraday trades. These are typically going to be your Monday to Friday expirations. So Monday to Friday expirations, they're kind of high risk, but it lowers it much more than a day trade. It's just still a short amount of time where theta is still going to be kicking in, just because it's a lot less than that 45-day period where theta begins to become more accelerated. Next is going to be your swing trades. This is a little bit more pricey, a little bit, you know, more for the season kind of, I guess you can say trader trying to get their feet wet, you know. These are good in terms of low risk, but they're just more pricey, right? You do want to have a little bit more capital when beginning to trade swing trades, but just make sure you're well informed with them. And these are typically going to be your 30-day, sometimes, you know, 3 weeks is considered a swing trade. 4 to 6 months, that's a good kind of swing trade, giving yourself more time for the share price to go into your direction. Time is going to be your friend, and that's really what's going to minimize the risk here. The longer you have with it, assuming it's going in the right direction and not, you know, falling out the sky, you're going to be in pretty safe hands here taking some swing trades. Leap trades are when a company, let's say, is just starting, but they have killer future, you know, goals and products coming out that really can shape the, you know, the future. Hey, I think that, you know, Tesla can be something big in the next 2 years. Hey, let me take a leap trade on it. Buy these, you know, they are much more expensive, these 2-year contracts, and let them work for me in the next 2 years, because I want to be able to own this much shares, right? Using the option contract, I guess you can say leverage with it. So those are how you kind of gauge risk with your day trades, your intradays, your swing trades, your leap trades, your expiration dates. You know now how to pick them. Hey, if I have a in the money strike price, maybe I could go for a day trade, expose it to higher risk, right? If I have an out the money strike price, maybe I could go with more like a swing trade to minimize risk. You could blend in high risk strike prices with low risk expiration dates to kind of create this medium risk effect. And you can mess with them, and it just comes with more experience and a little bit more knowledge. But like I said, it gets a little bit more advanced, but that's why we're here at SoCal Trading Group. So the next one is managing risk before entering is your setup. You want to pay attention to what's happening on the charts. Trading without a chart is like trying to do mechanics without a screwdriver, without a drill, without any tools. Not going to get very far. So use charts and look for very sharp changes in price. I've said this multiple times in a lot of my trading analysis videos. This is the key right here. This changes everything. This is where it's the person that's paying attention that will make money. You know, this is where you have to dedicate a little bit of your time, your free time, to these charts in the mornings to see moves like this and capitalize on these opportunities. Look here on this oversold scenario. Share price came up, dropped very aggressively. Once she caught a bottom near support, immediately climbed up. If you can time that correctly with a day trade or intraday, you can make a really significant amount of returns right there, helping increase your profiting and also minimizing risk as you're not trading at necessarily anything in the middle. You're kind of catching this trend after it happened. And once you have proof of levels of support and price kind of slowing down on the sell side. So when you're in an oversold scenario and price is coming down sharply, you don't want to fall into the FOMO and sell with them. Sometimes you want to be patient, spot the opportunity, and go against that trend for calls. That's where the money's going to be made. And in overbought scenarios, when share price moves up aggressively and starts to find that ceiling where it wants to come back down, boom, that's where you kind of want to take the risk and enter your put options, go against that trend. Because when share price climbs up aggressively, it, for the vast majority of times, comes back down. And that allows you to now not necessarily fall victim to these very aggressive moves and riding that train when it's already reaching its stop, you know? It allows you to be patient and find opportunity when prices are flipping, when sellers are stepping in, when buyers are leaving. So when an overbought scenario is happening, always look for put options. Next, understanding technical analysis. This is a make or break for so many people because, like I said, trading without a chart is literally like doing mechanics without your tools. So when breaking down a chart, you're going to notice levels. You're going to see things happening here. You're going to notice that, you know, around here, I have levels. I have points where price is respected. Price jumps up, jumps up, jumps up. Price comes down, comes down, comes down, comes down. Also at demand, price rejects. There's share prices where buying and selling is occurring more than in other share prices. And you want to chart these out so you know how price is going to react or somewhat predict how price is going to react near these levels. So I usually use 4 levels. Near my demand being always my ceiling, my roof. But you have to be careful when setting your demand that you're not charting an outlier. Look at this area up here at the top. This area up here at the top, whoa. This area up here at the top, it's out. There's no consolidation. There's no real data. So I can't count that as my ceiling because there's not a lot of contact there. There's not a lot of real, I guess you can say, sustainability. Down here, I have 1, 2, 3, 4, 5, 6 times that price tried to hit that and couldn't get above. That's where I'm going to want to be a little bit more realistic and set my demand. But below that, you can see there's a level as well called your resistance. You know, resistance is kind of where there's selling pressure, but there's still a possibility for buyers to break above. You know, a level like your demand, it's a lot of selling pressure, and that percentage chance of buyers breaking above it begins to slim down. You know, I tell myself this is where 80% of selling happens, and there's that 20%, you know, going on that could potentially break through. Resistance is that area where 60% of sellers are at, but there's still some aggressive buying to potentially push it up higher for demand. And support, finally, down here at the green line, you'll see price hits and comes up, price hits and comes up, price hits and comes up. That's where 60% of buyers are at. That's kind of like that fair range where, hey, maybe I didn't get the best deal, but I'm still going to be participating because I believe this share price will go up. And 60% of buyers are always going to be buying there, but there's always going to be those sellers, you know, that 40% of there that could push it back lower to the supply. And the supply is where people are getting the best deal, that no-brainer price to buy this share because it's going to be something valuable later on. And there's very heavy buying going on at that level. And those are the 4 levels that you want to have written out on all your technical analysis when trading, you know, here using a chart. And it's going to help you a lot in calculating when to enter. You know, at a supply, you always want to look for your calls. And when am I supposed to be taking profits? Like, where should I be looking to kind of get out? I sometimes tell people when you're just starting, bro, treat it like a staircase. You know, ride a supply to support. Hey, if that trend is strong, go from supply to support. Try to hit resistance and take profits there. You know, go level by level by level, but don't get too greedy expecting to go for the full thing sometimes, you know. Sometimes they happen, but sometimes they don't. So you build up that experience and just use every key level as just a back of your head tool to know, hey, around this level, there's some more selling. I should think about taking profits. And like I said, use it like a staircase. It helps you a lot. Managing risk before entering. Finally, the last component is your research. This is huge, bro. I can't tell you how many times I've taken trades with, you know, FOMC happening, interest rate cut decisions. You can say, man, headlines coming out, Donald Trump even tweeting, bro, in April, in March, bro, Donald Trump controlled the market with his Twitter. Absolutely hectic environment to be unaware of these headlines, right? So your research, when entering, even when in a trade, you want to have as much as you can. And there's 3 data sets that I've learned with my experience that are extremely important to have at least references from, to know about, to know that your trade is either safe or at high risk, to know the market's environment, know what's happening around you so you're not, caught victim by the, car you didn't see coming. So gathering information before entering to have greater conviction. Like I said, sometimes when you say like, hey, Donald Trump announced this $100 billion investment into Apple, and I think that share price could potentially go up. You have that research, right, to give you greater conviction when that trade goes down. You're not too on the edge. You're not too scared. You're a bit more confident. You're a bit more composed when in it because you have evidence. And gathering information after entering to have confidence, allowing you to, hey, I believe in this. It's okay if it goes down. I know it will come up because of these data sets I collected. Allows you to navigate your position's expiration date and strike price a little bit better. You know how much time you need for the move to happen, and you know how far out the money you can go or how far in the money you have to be to minimize risk or increase profits. So the last 3 important data sets that I highly recommend as a beginner you begin to collect, first is going to be your company data. Listen to their earnings calls, what is their forward guidance? What is their CEO saying about what are they struggling with? Listen to those earning reports, what are their numbers, their revenue numbers, their earnings per share numbers, their capital expenditures, you can say their buybacks, it's a lot of different components in those reports that you want to know about. Look at data analyst buy ratings, is Bank of America bullish on this stock? Is Goldman Sachs bullish on this stock? Is JP Morgan bullish on this stock? What are firms and analysts saying about this company? Is it rated a sell, a buy, or a hold? What are the headlines? What are the news reporting? The Wall Street Journal, Barron's, what are these big Yahoo Finances, media outlines saying about this company that is going to either drive price up or down that I should be aware of? What are some upcoming partnerships, Companies sometimes go ahead and sign multi-billion-dollar deals, and this attracts investors. This attracts buying as they can potentially create more profits for the company. What other product launches are coming? You can see Tesla releasing the Model X, the Cybertruck, the Cybercab. This created a lot of new revenue, a lot of new investor sentiment to come and attract these investors to push the stock price higher. Sector earnings, being aware, when is this company reporting, earnings as a sector. Tech week, as we seen last week, created immense volatility in the market. And if you were going against that, you pay the price for it. So being aware of, sector earnings. And finally, insider buying. Every now and then, if you're following the right information or resources, you'll see people like President Trump build very big, share positions. The CEOs build very big share positions, or some, outright investor just put multiple millions down behind a trade, potentially for a reason, right? Finally is your macroeconomic data. CPI, inflation rates. The Bureau of Labor Statistics releases this data on a month-to-month basis that you should be aware of. The unemployment rate, job reports, initial jobless claims is how they appear on the economic calendar. FOMC interest rate cut decisions. When is the Federal Reserve going to step in and address the nation on what potential interest rates can be in the near future? Will they be going up and driving prices of goods to go higher and businesses to make less, bringing the stock market down? Or will interest rates go down, allowing cheaper borrowing for companies to borrow more, expand more, create more business, and allowing the stock market to go up? So you learn the correlation. You build these data sets to know, hey, stock market has more of a chance of going up or down before even entering. What are oil prices? Oil prices oftentimes are an indicator of inflation. If fuel costs are very high, transportation is very high. Transportation's high, cost of goods also increase. A little bit of a guide for inflation. Gold prices. If you see gold and silver beginning to go up, sometimes it's because people are unsure about the stock market. Political data, presidential elections, government social media posts. We've seen that in March and April. Absolutely crazy. Presidential elections, we have here in 6 months the midterms. This is creating Trump to move a certain way, move maybe more aggressively in certain of his, I guess you can say, administration's goals, right? To gain the voter confidence, that re-election for him. A social media posts, new laws and acts, the Clarity Act was a big one. Sometimes cannabis law changes was a big one, created a lot of opportunities out there for people. New laws often get in place back. You've seen the 2020 tax EV credit. That was a huge one that made electric vehicles skyrocket. So there's these political changes in laws and in acts that sometimes drive share prices to go up. Newly elected Federal Reserve Chairman, I'm seeing this with Kevin Warsh, first time in my history, the change of a chairman, how that impacts investor sentiment. Lawsuits and appeals, sometimes one company will get sued for, wrongful, deaths. Really big lawsuits can impact companies. You see Meta, recently get sued for being too addictive, and they won that. So these impacted the share prices and investor sentiment as well. And finally, holidays, sometimes people forget about holidays like Good Friday. There's some, like Columbus, like some presidential days that people don't even know about, that they often just slide under the rug, living our day-to-day lives busy. We kind of forget about. And the market could be closed. That can cost you a whole day on your expiration date and in time decay that you want to be aware of. Finally, is, like I mentioned, time decay, this big secret killer to options, how time erodes option value. So think about this like a used car. If you buy a car with 0 miles, brand new, I'll pay you the best dollar bang for your buck right now, top dollar. But the second you start putting 20,000 miles, 30,000 miles, 40,000, 100,000 miles on this engine, the value of that car deteriorates. Same thing like a contract. You buy it fresh, as it gets closer to the expiration, it goes down. It loses share value very significantly. So theta measures how much an option loses in value each day, or sometimes hour if you're taking day trades, due to the passage of time alone. It's always working against option buyers. Theta does not stop when markets are closed. It is correlated to time, not market hours. So if your days and markets are closed over the weekend, you are going to lose a weekend worth of theta or option value to your contracts. So be aware of this when picking expirations, picking strike prices, and navigating the life of your option. Key facts: theta accelerates as expiration date approaches. When you get closer to your expiration, theta is going to be more aggressive. At the money and out the money options have the highest theta. At the money and out the money, like I said, are that medium risk or high risk. In the money are always going to be less exposed to theta because they've already kind of safe in the net. Medium and higher risk are going to have a little bit more exposure to this time decay. Theta is the highest in its final 30 days. So before that 45-day mark, you want to be able to start, hey, should I take my profits? What am I doing? Because theta is aggressively impacting me here. So be conscious of this, right? An example, you buy a call option for $3. Remember, $3 times 100 shares in each contract. It's going to be $300 total with a theta of minus 10. So that means that every day, if the stock stays flat, doesn't go up, doesn't go down, why would I lose money? Well, you're going to lose money because the life of that contract's expiring. It's burning like a candle. So you're going to lose 10 cents or $10 per day. If 10 days that goes flat, nothing happens, boom, you just lost $100. $10 times 10 is $100. Your cost was $300. You just are now at $200 a share or contract value without nothing happening. You lost 33% of your investment to time alone just because it's nearing the expiration. No implications, no, I guess you can say, impact from share price changing. This was all just time. How to manage theta? Buy options with more 45-day expirations, longer times out. This minimizes risk. This allows for, hey, you to have a little bit more composure in these swing trades, right? The medium risk. You're not impacted by this too significantly compared to intradays and day trades. Collect option profits early in the contract's life. I tell my guys this all the time. When you're going into swing trades, yes, you have the expiration, but it doesn't mean you have to hold until then. It doesn't mean you have to wait until then to sell. If you see a generous return, you see an aggressive price move, you see a nice capital number of return you like, take it. Do not wait till the end of that contract's life sometimes to pay yourself unless you have evidence. But if you are trading just based on price action, sometimes taking profits early can help you, and you won't worry about theta as much as you will later on in the life of the contract. Also, helping with theta is averaging your cost per contract if theta has consumed your contract's life. So if I bought a contract at 6 a.m. on a day trade, by 10 a.m. this thing is almost worth borderline nothing because of how much is lost to theta. So my initial investment that's way up here now is impacted by theta weighing me down here, valued here. Maybe if I buy more, I can average my costs lower. So when share price goes up, I'm not waiting to be up here to make profits. I'm not waiting to be here to make profits. And that's averaging your cost, which is, like I said, a little bit more of an advanced strategy that we cover here at SoCal Trading Group. And it just takes a little bit more experience, more help with navigating. I don't recommend getting your feet wet with that just all by yourself. And avoid holding cheap day contracts and week-long contracts for too long. Sometimes if you're on a day trade, 6:30 to 10, 11 a.m. is now pushing it. If you're in a week trade, Monday to Thursday is now pushing it. You're losing life of value. Despite share price going in the direction of your strike price, it still might not pay you as much as you think or recover those losses as much because the life of that expiration is so slim. You've lost a lot to theta. And exit trades before the final week acceleration, which is that last 7 day where theta is just extremely high. Takeaway: time is always working against you for option buyers. Plan your trades with expiration in mind. Finally, there's a testimonial. I myself did this. I know it's very possible to take $100 into something great. Is it easy? Hell no. Is it possible? Yes. It's just a little bit of a challenge, a lot of patience, and this is my proof. I did a small account challenge initially with $300. We took it at $350 at the start of April 16th. Later on, update on May 19th, we were up $8,000 in just 1 month. Brought the total account to $7,911 in just 30 days. And this is, we did it here with my trading group. I'll show you my guys' profits with me on the next slide. But in just 1 month, I was able to generate 23.133% gains in profit and just trading options with zero DTEs and low capital, helping beginners turn 100 into 1,000 to show you guys that it's real, it's possible. My credibility, what was my biggest trade that really showed me that this is real and it's something I want to learn is, back in April 4th of 2025, I took my biggest trade for 25.7 thousand. It turned into 116.3K in less than 3 hours, and that was a 452% return for me, and that really changed my life and sparked everything differently. And man, highly recommend you guys get into this with the right experience, the right help, the right guidance, because it's something that can make you a lot of money once you learn it and you get very experienced and I guess you can say more professional with it. Finally, start your investing journey. Here in front of me, I have some of my student profits making $3,300 in 1 day, another $1,200 in 1 day. My buddy Stevie bringing home $2,300 in 1 day. Art Zavala bringing down $3,500 in just 1 day. Over here, my buddy Peter, he's bringing down $4,833 in a position of, I guess you can say, MSTR here that we positioned ourselves back when Bitcoin was so cheap. Over here, my buddy Noel sending me his profits, over $1,600 in profit on 1 day in a swing trade he took with United Healthcare here at SoCal Trading Group. And if you guys want to get to learn more about this, you like the information, the presentation, you want to get and build your experience around this, get familiar with the stock market young, reach out to me at my mobile number 909-695-6336 or my Instagram at jerry'sinvesting_. I just made a new one. It got deleted. Unfortunately, I don't know why, but I have been able to, unrecover it. So I made a new one starting from zero back up. And my email is at SoCalTradingGroup@iCloud.com if some of you guys prefer to email me. And my TikTok is at Jerry's Trading. Be careful because there is fake accounts. accounts. And finally, any questions and answers, you guys can always reach out to me at 909-695-6236. Go ahead and call me and I'll be glad to help you guys. And finally, that concludes it. So I really hope that you guys enjoy this presentation and it's able to help you guys to the best of my ability. And I really, thank you guys for giving me your time. I hope this helps you guys better understand options on a level that no one taught me yet. And you guys can see, the potential reward with learning the skill set, and it's something you can all do from your phones. So you can mix this in with your job, mix this in with your business, mix this in with your retirement, your 401k, your Roth IRA, your high yield savings, your pension, all those traditional investments. You can exert yourself. You could put a little bit extra work. You could be the guy growing and managing your money. Just learn it. And with it comes, now I'm the bank, I'm the tool. You give me money, I can make more with it. Why? Because I learned, and that makes you a very valuable individual. So I'm glad to be able to share this information and help as many of you guys as possible. Thank you guys once again. If you guys have any questions or concerns, call me at 909-695-6336. I'll be glad to work with as many of you guys as possible. I wish you guys all the best of luck on your option trading journey. Thank you guys once again. Let's go ahead and wrap it up here. Jerry Trades of SoCal Trading Group, over and out.